In this video, we're going to talk about how buyers value privately held companies. Now, most of our clients that we deal with clearly understand how to value a publicly traded company. Simply take the amount of shares outstanding times that day's price in the market, times the two together, and you end up with the valuation of the company. Fairly easy and straightforward. Unfortunately, valuing privately held companies isn't as easy and or straightforward. There's really, at the 50,000 foot level, an equation that most buyers use when valuing companies. It is earnings times a multiple equals the enterprise value. So let's talk about the two major components that make up that formula. So let's start by talking about earnings and what we need to do to take a look at the cash flow that the company kicks off. Now the earnings segment, we actually take and adjust it for tax strategy, non-recurring expenses, owner's benefits, and then finally we'll make some market adjustments to such things as rent and owner's compensation. So let's talk about taking the tax strategy out of your pre-tax earnings. Most owners that I know work really hard to make as much money as possible. On top of that, they also work with their accountants to try and figure out how to write off as much of their expenses or benefits as possibly that they can. So we're going to take the tax strategy and add that back to your bottom line. So again, we want to start with a net income pre-tax, and to that we're going to add back your interest, depreciation, and amortization. And that's pretty straightforward. Three items, you add that back and you'll end up with a number. From there, we want to take a look at the non-reoccurring expenses. Now this could be a one-time expense to have somebody come in and look at your QuickBooks and clean them up. It could have been a leadership conference that you've attended that you'll probably never take back. That's where it gets a little creative and you need to work with an M&A specialist to see if those make sense. On top of that, we want to take a look at owner's benefits. So are you writing off a personal car, second home, motor home, boat, club membership? So those types of benefits that an owner gets that would not move with the company to a new owner. So you'd add those back as well. And then finally, we want to talk about market adjustments. So the first one we really talk about is the owner's compensation. Now, owner's compensation, your salary, will be adjusted for a new owner for this purpose of figuring out your cash flow to market rate. So if you're the acting president and general manager of your company and you're paying yourself a $300,000 a year salary and the market rate for replacement for your job is say $100,000, in that case we'd want to add back $200,000 to your bottom line. Now, businesses are valued separate from real estate holdings. Again, we're taking a look at the cash flow that is associated with your business. So if you own the building or facilities that your company operates in, one of the questions we have to ask is, are you paying market rent? Now, if your rent that you're charging yourself is below market, we actually have to increase that expense for current rent. If you're overpaying, then we'll actually take some of that off. So with walking through these adjustments, we're ending up with a cash flow or adjusted cash flow or EBITDA for your business. Well, now that we've examined the cash flow portion of the equation, let's talk about the multiple and what drives the multiple. We've come up with over the years what we call our top 10 list of multiple drivers. And the first one is revenue. And the question you want to ask yourself when evaluating revenue is not only the scope of the revenue, i.e. how much, but the historical movement in that revenue. Is it staying flat? Is it growing? Or is it decreasing? The answer to that can have an effect one way or another on a multiple. The second one is gross margins. So the gross margin associated with your business, is it standard for the industry, above standard, or below standard? Is, in addition, on a historical basis, is it moving up year over year, staying the same, or decreasing? Again, the answer to that will have an effect on the multiple. Third, what industry are you in? Some industries are very industry specific as far as multiples, and it can be very limiting on what you're able to get for your business. But generally, we ask, are you a wholesale distributor, manufacturer, or service company? If you're a manufacturer, you usually have a higher multiple than a service company. And this really is a result of the asset base that's required to be a manufacturer and to support that cash flow. Reoccurring revenue. Is your revenue from your customer base reoccurring, or are you depending on a new sale to a new customer for every dollar? If the answer is, geez, I've got 50% of the revenue comes from repeat customers, that's great. That has a positive impact on the multiple. Customer concentration. So is 10% of your revenue coming from any one customer? If the answer is no, again, that's a good factor to have. If it's, I've got 2 customers that represent 50% of my revenue, that will probably decrease that multiple unless there's a real good explanation, long-term contract, something of that nature to offset the risk with fewer customers and taking up a bigger revenue portion of your company. Seasonality versus non-seasonality. If your company is seasonal, that has an effect on the multiple. Now, the only exception to that rule is we've had a few companies that we've sold where another counter-cyclical company has come in and bought it, and that has driven the multiple up because it's so attractive for them to become a non-seasonal or non-cyclical revenue company that they were willing to pay a premium in that case. IP, intellectual property, patents, and trademarks. So do you possess something that's unique in the market? Do you have a process or a product that has been patented and or trademarked? That type of intellectual property can give you a distinct advantage in the marketplace and thus enhance the value of that multiple. Growth opportunities. Now, growth opportunities can be looked at in a couple of different ways. First of all, the industry that you're in, is there a very large outlook for continued growth in the market? And your particular business, have you identified growth opportunities, and is your company in a position to take advantage of them? If the answer is yes, then that's probably a positive impact on that margin. Barriers to entry. If anybody can get into the business that you're doing with little or no expertise or capital, that'll have a negative impact. However, if there's a great deal of capital and or expertise and licensing required to do what you do, that's good. That eliminates some of the potential competition down the road and gives you a better influence on that multiple on a go-forward basis. And finally, our number 10 item, which is adjusted cash flow greater than $1 million. Now, this really talks about the scope and size of your company and will make your company appeal to a much larger base of buyers. And this will actually push you into a base of buyers that are known as private equity and portfolio groups. And they will sometimes pay a higher multiple for companies that they can either operate as a platform or plug into one of their other companies as an add-on. So that does it for multiples. Those are our top 10 lists. Hope that's been helpful. One thing that we always talk to our clients about is thinking about taking a look at these multiple drivers on a year-over-year basis and doing an evaluation to see how you stack up. These are the things that if you attack year over year, you can actually move the value of your company. Our hope is that this video has been somewhat educational. Our goal is that you walk away with a better understanding of how buyers value business, and also a couple of hints on how you might increase that value over time. If you'd like to talk to us about valuing your business, please give us a call at 503-233-8600 or visit us on the web at www.thecbbgroup.com. And thanks again. Enjoy your day.